Ladies and gentlemen, welcome back to the channel. We have a breakdown of the debt ceiling deal that was agreed upon this weekend that's going to be going to the House and the following Senate and then Biden later throughout this week. Now, I want to talk about the implications of this for the markets because after all, the markets have been rallying about 10% on the NASDAQ in the last month in anticipation of this deal getting done. Nobody expected the United States to default. And now that this deal is done, how are the markets going to be affected by this? We're also going to talk about earnings in the next upcoming week, as well as economic data that you need to know, give you a rundown of the situation with AMC, and get you guys caught up to speed. So let's dive into it first with what's in the debt ceiling deal itself. A cap on discretionary spending. The deal would suspend the $31.4 trillion debt ceiling until January 1st, 2025, allowing the U.S. government to pay its bills. In exchange, non-defense discretionary spending would be roughly flat at current year levels in 2024 when factoring in agreed upon appropriation adjustments, according to White House officials. They estimated that total non-defense discretionary spending, excluded benefits for veterans, would total $637 billion for the 2024 fiscal year, down marginally from $638 billion the year before. That total would also increase by 1% in 2025. A breather for the 2024 election. They would just extend this past the 2024 election, which is November of 2024, so we would be back to the same situation by early 2025. An increase in defense spending. The deal would boost total defense spending $886 billion in line with Biden's 2024 budget spending proposal. That is about a 3% increase from the $858 billion allocated in the current budget for the Pentagon and other defense-related programs in other agencies. Removing special IRS funding. Biden and Democrats secured $80 billion for a decade in new funding to help the International Revenue Service enforce the tax code for wealthy Americans. In last year's Inflation Reduction Act, a move the administration said would yield $200 billion in additional revenue over the next 10 years. And it's basically cutting this back by about $10 billion over the next 2 years. The COVID clawback. Biden and McCarthy agreed to claw back much of the unused COVID relief funds as part of the budget deal. The estimated amount of unused funds is between $50 and $70 billion. White House officials said some funds would be retained, including items related to vaccine funding, housing assistance, and support for Native Americans. Work requirements. Biden and McCarthy battled fiercely over imposing stricter work requirements on low-income Americans for being eligible for food and health care programs. No changes were made to Medicaid in the deal, but the agreement would impose new work requirements on some low-income people who receive food assistance under the program known as SNAP up to age 54 instead of up to age 50. Student loans. The new bill would require the Biden administration to follow through with a plan to end the current pause on student loan payments by late August. Pay go, basically pay as you go. This is kind of like we'll spend more if we save more. So if you save some over here, you can spend a little bit more over here. Energy permitting. Biden and McCarthy agreed to new rules to make it easier for energy projects, including fossil fuel-based ones, to gain permit approval. McCarthy and his Republicans had identified permitting reform as one of the pillars of any deal in the White House through its support behind the plan earlier this month. So you're really not getting a huge drastic change. Some things are positive, right, for the market. Looks like less taxation. That's probably going to be seen as positive, but it's not really enough cuts to spending to be a problem to the markets, and it's not really enough cuts to spending to make markets excited about lower inflation. This is really not going to affect all too much in the grand scope of things, and that's why a lot of Republicans really don't like this deal. This says Republicans criticize McCarthy Biden debt ceiling deal. A lot of them are, quote, going to try to stop it from passing the House, because they're basically saying, hey, we had the power to get a bigger deal done and to enact more spending cuts, and McCarthy didn't take that opportunity. So it's going to be an up and down rocky battle. So I think that's definitely going to kind of move the markets. This isn't a set in stone deal yet. You still need to get this passed through the House and then through the Senate and then ultimately to Biden. As of futures right now, NASDAQ futures are up 0.35%, S&P up 0.30%, and the Dow is up 0.31%. So about 1/3% across the board, and you're not getting a bigger reaction here because, I mean, look at the NASDAQ on a weekly chart. It's went to the moon already. This is ultra aggressive of an upside move. And it's been implying that the debt ceiling deal was going to get done, and you've already priced that into our markets. Now, one thing that I want to tell you that is kind of dangerous from here is on this weekly NASDAQ chart with the RSI, last time you were overbought was the week of November 19th. The next week, you hit a new all-time high briefly, and then that next following week, you fell 3.17%. So, last time you were overbought, things quickly started to deteriorate. And now you are overbought again. You're over 70. You're at 70.82. Even back here in, 2019 and early 2020, before the COVID pandemic, markets were extremely overbought on the NASDAQ. And then, you fell. History, is pretty clear. 2018, the crash later in the year, you got overbought. August 31st, 2018, you hit a low the week of December 21st, 2018. So again, another fall. Even back here again, smaller drop, like 7-8% in total in early 2018. Markets were overbought before that, little crash happened. And you can basically take this all the way back to history. And every time you get overbought on the NASDAQ, you tend to fall after that. So maybe this is bucking the trend. Maybe it could stay like this and go higher for a while, but it's not a very positive sign. It's not a good trend. Now, as investors in AMC, I know a lot of people are going to be excited about that, because that means maybe less collateral, maybe a little bit of stress on hedge funds and institutions. Now, what we really are going to see this week as far as earnings, some pretty notable names actually. Tuesday, after hours, you're going to get HP and Hewlett Packard Enterprise, as well as Box, Sportsman's Warehouse, Joy, Agora, BTC.com. Wednesday pre-market, Advanced Auto Parts, Capri. Wednesday after hours, CrowdStrike, Salesforce, C3 AI, Okta, Chewy, Nordstrom, Viva, Pure Storage, NetApp, and PVH. Thursday pre-market, Dollar General, Macy's, Billy B, I think that's how you say it. Hormel Foods, Duluth Trading, basically it. Thursday after hours, Zscaler, Broadcom, Lululemon, ChargePoint, Dell, and Five Below that will be reporting earnings. So you do have some notable names this week. AI again, it's going to be pretty big. CrowdStrike, Salesforce, and C3 AI being some of the big ones. So that is what we have this week as far as earnings. If we take a look at the economic data that will also be coming out this week, we are going to get, let's go ahead and pull this all the way back to Monday. Tuesday. On Tuesday at 9 o'clock in the morning, you get S&P Case-Shiller home price year over year and month over month. CB consumer confidence for May. Dallas Fed manufacturing index coming in at 10:30 in the morning. 3-month and 6-month bond auctions, but a relatively dry day overall. On Thursday, you're going to get JOLTS job openings for April. This number has been trending down. And last month it was at 9.59 million. This month you're expecting it, or for the month of April, you're expecting it at 9.2 million. So you are expecting the labor market to get a little tighter on a month over month basis. Now at 10:30 in the morning, you'll get the Dallas Fed Services Index. You're forecasting a negative 15 reading. Last month's reading was negative 14.4. So not a lot of data coming in Wednesday as well. Thursday, you're going to get initial jobless claims, non-farm productivity quarter over quarter, unit labor cost quarter over quarter, ADP employment change for May. This doesn't tend to be as big as obviously the government reports. But it still is something to watch and can be important. That comes out at 8:15 in the morning on Thursday. Forecast 200,000. Last month's reading was almost 300,000. So a deceleration as well in the labor market in that data report is expected. 10 o'clock in the morning, ISM manufacturing PMI for May. You're expecting 48. Last month's reading was 47.1. So things to get a little bit healthier there. Some more bond auctions throughout the day as well on Thursday. Big day for economic data is going to be the unemployment rate for May. You're expecting that to go to 3.5% from 3.4% in the month of April. Non-farm payrolls are expected to rise 180,000 jobs. Last month's reading was 253,000 jobs. So if this number, comes in higher or lower, that's going to be a big deal for this market. And that's probably going to give you the, biggest reaction of any day this week. Probably going to be Friday, depending on if we get any, black swan kind of news that we're unforecasting. If we got a credit downgrade or something crazy along those lines, I think that would definitely hold precedence over all of this data. But we can't sit here and forecast that to you as of right now. So there you have all of that. If we take a look at AMC stock and where AMC currently is at, obviously the option activity is reigning supreme with AMC. It is really... There's nothing you can really do to this. Hedge funds, institutions, they're going out and they're buying those deep in the money puts, forcing the market makers to short stock. I like to call it synthetic shorts because it's not hedge funds shorting shares, it's market makers shorting shares. And you can't quantify that. You can't figure out exactly where the short interest is when they are doing that, because market maker shorts, kind of like a gamma squeeze, you just never really know how many shares market makers are buying, right? It all has to do with how many options are being bought. So you do have a lot of potential buying pressure right now in AMC stock from the market makers. And it's very well possible you could see a gamma squeeze in this week, next week, anytime now, because of how short hedge funds and institutions are at that $10 put that's deep in the money, with those break evens around $4 to $5 a piece. If AMC stock can start to break out above $5 again, that's where you're going to see a lot of buying pressure coming in from those market makers. If we take a look at the overview of the short positioning in AMC stock, the short score sits at 90. The short interest value, basically dollar amount, $505.33 million. Estimated short interest of free float at 21.09%. Free float out on loan at 34%. Shares out on loan 175.4 million. Days to cover 6.18. Cost to borrow 55.19% and 100% share utilization. Cost to borrow fees have been very volatile. Last we knew on Friday, the cost to borrow max was around 109%. Cost to borrow minimum about around 8%. Cost to borrow average around 68.5%. Interactive Brokers has a cost to borrow fee of about 51%, with 500,000 shares that are currently available to be lent out. So the situation here looks more bullish than not because of the possibility of a gamma squeeze. The possibility of a gamma squeeze is massive over the next couple of weeks because of all of those deep in the money puts that market makers have shorted stock for. 20 to 40% of the volume on any given day is market makers shorting stock because they continue to buy these deep in the money puts. So when you think about it in terms like that, it's not going to take a lot of great news to get you a very big rally in AMC share price. So there is that. Another thing you want to watch this week is the Fed rate monitor tool. It's sitting at a 64.2% chance of another rate hike in June. Markets have just went higher as the probability of a rate hike has went higher as well. So really disregarding the Fed here, markets are really not caring what the Fed is going to do. Who knows if that does come back to kind of haunt the markets, if markets do all of a sudden start to care about rate hikes again. That's not going to be a positive thing. But I don't know if that's going to happen. Now, on the other hand, you are seeing the breadth is very, very bad. So a lot of the collateral, a lot of the capital is really condensed in these big tech names. And you can see big tech continues to go higher, leading the NASDAQ up, the QQQ, to just go parabolic at this point. And the average stock has actually been declining for months now. So most stocks are flat or negative on this year, and the top 5 or 10 companies where all of the money is concentrated in and all of the collateral is in for AMC short positions has only went higher. When that does reverse, markets do eventually fall, because markets will eventually fall. That is not going to be a positive thing for the hedge funds that are short in AMC stock, guys. So that is going to do it here in this video. Hit that like button and subscribe to the channel. Source your comments, questions, or concerns down below in the comment section. You guys have a great rest of your day, and I will see you in the next one.